Welcome to the Deep Dive. This is where we dive into, well, huge amounts of research, history, financial filings, all that stuff, and boil it down into the key insights for you. Today, our mission is pretty ambitious. We're taking a comprehensive look, spanning a whole century, really, at how financial empires get built, how they're sustained, and sometimes how they spectacularly collapse. We'll be covering the core tactics used across, 100 years of high-stakes capitalism.
Yeah, it's a massive scope. We're talking everything from, oil refinery consolidation back in the 1890s all the way up to crypto or digital currencies today. But what's really striking when you synthesize all these sources is, well, there's this powerful constant. The tools change, definitely. Railroads, ports, then junk bonds, now maybe SaaS platform.
Right, the technology, the instruments evolve.
Exactly. But those fundamental drives, power, dominance, accumulating wealth, they often seem, well, maybe shockingly consistent across all that time.
That's a big claim, though. Consistent drives. How can you really compare, say, the brute force needed to control a railroad in 1900 with the algorithmic skill needed to trade stocks in milliseconds today? Seems worlds apart.
Well, the comparison isn't in the specific skill, maybe, but in the leverage points. It's always about finding the choke point.
Right.
And then monopolizing it. So whether that's physical control over infrastructure or financial leverage using debt, or today, maybe it's information asymmetry, the goal is often the same. Find that key point and control it.
This deep dive, we're going to pull from sources covering, everything from corporate cartels and those early industrialists to tech plutocrats today, the sort of magic around valuations and the real-world impact these financial games have.
So we're essentially drawing a line from the original, the robber barons, straight through to the modern billionaires club. We want to get past just who got rich.
Right.
And really understand how they wielded that power. What did it look like on the ground? And what were the consequences for everyone else? Exactly. We're trying to answer that big question. What does unchecked financial power actually look like in different times? And crucially, how have those power structures shifted? How have they adapted to new regulations, new tech, different political winds?
Okay, let's unpack this. Let's start right back at the beginning, maybe. The foundations of American capital, those original patriarchs. Yeah, when you think about the early giants like John D. Rockefeller Sr. and Standard Oil, the first thing that comes to mind is usually, ruthless monopoly.
Yeah.
Crushing competitors.
Sure, and that's definitely part of the story. But what's interesting looking at some of these sources is how he operated internally. His management style, surprisingly, seems really focused on consensus, internal harmony almost.
Consensus.
Yeah.
From the guy who controlled 90% of the oil refining. How does that work?
Well, the descriptions paint him as sort of a laconic figure, quiet. Apparently, he rarely gave his own opinion until he'd heard everyone else out. Getting the group to agree was paramount. He wouldn't just issue orders. He'd frame his decisions as a suggestion or maybe a question, always working towards some kind of compromise that kept his partners, these really strong-willed, often ruthless guys, on the same page.
But why? If he had the ultimate financial clout, why bother with getting everyone to agree unanimously? Seems inefficient.
But the key, according to these accounts, was risk management, long-term stability. The idea was that if any plan had to pass this incredibly tough test, getting unanimous approval from the smartest, most aggressive minds in the business, then Standard Oil was less likely to make huge mistakes. They apparently believed internal conflict, internal fighting, was a bigger threat than competition from outside. Rockefeller himself is quoted somewhere saying the goal was to make sure that we were right and had planned for every contingency before we went ahead.
So the power wasn't just in owning everything. It was exercised through this carefully orchestrated consensus, ensuring flawless execution by getting everyone bought in.
Exactly. Now contrast that with, say, a contemporary like Henry Ford. Totally different approach.
Right. Ford's power wasn't about consensus at all. It was pure cult of personality, wasn't it? It was all about him.
That's exactly right. You look at his ads, they explicitly said the quality of the Model T was guaranteed by the man himself, Henry Ford. He was literally selling the car based on the public's trust in him personally. He wasn't just the CEO, he was the product, the brand, the guarantee.
But that kind of intense personal control had a dark side, didn't it? It led to that big public backlash over his sociological department, people calling it a feudal system.
Yes, and that's where you really see the edges of this unchecked power, the sociological department. Ostensibly, it was set up to make sure workers were living up to the moral standards Ford thought they should meet to earn his famous $5 a day wage. High wages, but with strings attached.
Serious strings, right?
Yeah.
Like inspecting their homes.
Oh, yeah. Auditing homes, checking bank accounts, enforcing temperance. Investigators would literally go into workers' houses. They'd check for cleanliness, see if they were saving money, make sure they weren't drinking too much or smoking. It was incredibly intrusive.
And that's what papers like the New Haven Journal-Courier jumped on. They basically said, look, paying good wages doesn't give you the right to control someone's private life. The
Yeah.
argument was fundamental. Once a worker's day is done, they're their own boss at home. That's the American way. So even back then, you see this immediate fear that too much corporate power starts messing with basic liberty. Control over your job becomes control over your life.
Absolutely. That anxiety about corporate overreach, it's a theme that just keeps popping up. Now, if we shift gears a bit, look globally. We see different routes to dominance, but often just as rigid, especially when governments get involved, granting exclusivity, fostering cartels. That gives companies a guaranteed structural edge.
Okay, before we jump continents, I'm stuck on this control thing. Rockefeller's consensus, Ford's personal oversight. How does that old-school American model compare to, say, the government-backed monopolies that emerged in Asia? This feels like where it could get really interesting. Look at Hong Kong, for instance, the cartel environment there.
Yeah, the sources really hammer this point about cartel characteristics in major Hong Kong businesses, especially those linked to big names like KS Lai. These weren't just companies competing in a market. They controlled entire essential sectors. We're talking real estate. The port's crucial for an island economy, power generation, cement, concrete, asphalt, even down to chain retail stores.
Wow, that's basically controlling the building blocks of the economy. Why those specific areas?
Because they're fundamental. You control the port, you control what comes in and out, control the power, you control industry and daily life, control cement, you control construction. The profits are almost built in because consumers often have nowhere else to go. It's infrastructure. And the philosophy, pretty blunt. Simon Murray, who worked for Lynette Hutchison, apparently said something like, Hong Kong is a cartel environment. If the government's going to give you a monopoly, grab it.
Okay, that's a world away from Rockefeller trying to build internal consensus to avoid mistakes. This is pure regulatory capture, leveraging government favor and structural necessity to guarantee profits.
Precisely. And you see that interplay between politics and business get even more direct, more overt in places like Thailand,
Right.
particularly with the rise of what's called big money politics under Thaksin Shinawatra.
Right, so his party wins big.
An unprecedented victory, actually. And immediately, key business backers like the huge CP Group, for example, they get rewarded with cabinet positions. The system was pretty nakedly about translating political support directly into financial advantage for allies.
So the political win directly enabled specific financial tactics. It wasn't just general influence.
Oh, it was very specific. Shin's own business interests, particularly in telecoms, saw immediate dramatic benefits. The tactics were all about manipulating the regulatory environment. For instance, his government just dragged its feet, repeatedly stonewalling the appointment of regulators for a new National Telecommunications Commission. Why? Because that commission was supposed to bring in deregulation, more competition. Blocking it protected the incumbents.
Like Shin's own companies.
Exactly. And they use things like interconnection fees. That's what rival mobile carriers have to pay to connect calls onto the dominant network, Shin's network in this case. They weaponized those fees, charged rivals heavily, but guess who didn't have to pay those fees on their own network traffic?
Fights companies, of course.
Mhm.
So block the regulator, keep the old favorable rules, and use those rules to bleed your competitors dry through fees. What was the bottom line impact of all that maneuvering?
The numbers are pretty stark. Profits for Shin's mobile company, Advanced Info Service, just exploded. They went from under 4 billion Thai baht in 2001 to over 18 billion baht by 2003.
Wow, more than quadrupled in 2 years?
Basically, yeah. And it wasn't driven by some brilliant innovation or service improvement. It was almost entirely down to hobbling the competition and blocking deregulation thanks to his political power. So, if that first wave of big capital was built on controlling physical stuff, oil wells, railroads, and maybe locking down markets through cartels or government deals, this next wave, the age of financialization, it's all about controlling leverage. Financial leverage.
Right, so moving into the 1980s, the whole game changes.
Right.
Forget controlling oil fields or getting government licenses. Now it's about financial engineering. Enter the corporate raiders and the leverage buyout, the LBO.
Yeah, the LBO became this incredibly powerful, almost feared corporate tactic. And the core idea was actually pretty simple, but devastating for target companies. It was all about spotting a gap, the gap between what a company's assets might be worth if you broke it up and sold them off, its liquidation value, and what its stock price was on the open market.
So managers in these new financial players looked at established companies like RJR Nabisco became the famous example, right?
The ultimate example. They saw it not as a functioning company making biscuits and cigarettes, but as a collection of assets. Assets that were worth way more taken apart, maybe restructured, maybe sold piece by piece, than the stock market was currently valuing the whole thing. It was like a hidden arbitrage opportunity waiting to be unlocked.
And the goal wasn't just profit for the shareholders who sold out, was it? It was about creating these absolutely massive windfalls for the deal makers themselves. Paid for how?
Paid for largely by loading up the company they just bought with enormous amounts of debt. That's the leveraged part of LBO. And just look at the scale of the potential payouts in that RJR Nabisco fight. Ross Johnson, the CEO leading the management group trying to buy the company, his inner circle, just 7 guys, stood to get a compensation package estimated at $1 billion, or maybe even more.
$1 billion. For orchestrating a buyout,
Yeah.
not for running the company for years, just for the transaction itself.
Exactly. That wasn't salary. It wasn't performance bonus in the traditional sense. It was their cut for executing the financial maneuver. It really shows that shift, right? From focusing on, I don't know, industrial production or long-term growth to focusing purely on the financial transaction itself.
It's mind-boggling. That kind of reward for a few weeks or months of deal-making could probably dwarf the annual profits of some of the factories RJR owned.
And it was so outsized, so aggressive, that even other major players on Wall Street involved in the deal, like Gutfreund at Lehman Brothers, reportedly called that package unseemly. It raised eyebrows even among the financiers. The whole atmosphere around these takeovers was just brutal, cutthroat, and incredibly personal. Sources mention reporting from the local paper in Greensboro, North Carolina, where RJR had deep roots stating flat out that key executives, like Horrigan and Johnson himself, would be terminated if the rival bidder, KKR, led by Henry Kravis, won the auction.
So these weren't just business deals, they were wars. Careers, reputations, everything on the line.
Financial wars, absolutely. And you couldn't fight those wars, couldn't launch these multi-billion-dollar takeover bids without ammunition. You needed fuel.
And that fuel came in the form of
Yeah.
junk bonds, right? High-yield debt.
Wow.
Junk paper, as the critics called it.
Precisely. You needed access to absolutely vast sums of this riskier high-yield debt. And that's where Drexel, Burnham Lambert, and particularly Michael Milken became so pivotal. Milken and Drexel essentially created and then dominated this market. They provided the financial firepower, making huge amounts of capital available to companies or raiders who couldn't get that kind of money from traditional banks because they were seen as too risky or their plans too speculative. Drexel was described as the largest piece of financial artillery on the Wall Street battlefield.
And the big players, the raiders like Ivan Bohesky, they weren't just using this market, they were dependent on it.
Completely dependent. The sources mention Bohesky being totally dazzled by Drexel's ability to raise money seemingly out of thin air. For one of his big corporate plays, Bohesky needed way more capital than he could possibly raise on his own. Drexel stepped in and delivered $100 million. That was apparently more than twice what Bohesky could muster himself.
So that $100 million difference, that shows you the power Milken held, doesn't it?
Yeah.
He wasn't just arranging loans. He was effectively deciding who got to be a major player, who got to launch these massive raids in the 80s.
Absolutely. The entire ecosystem, this whole LBO boom, rested on that availability of high-yield debt and the belief, maybe the myth, that these highly leveraged deals, even if they pushed ethical boundaries, were just too profitable to be allowed to fail.
Until, eventually, the whole thing came under intense regulatory scrutiny and started to unravel. What were the actual legal lines crossed? What brought Milken down?
Well, Milken's eventual downfall was sealed by his own detailed confession. It really laid bare how the system was being manipulated. His plea deal covered 6 felonies. It showed a clear pattern of illegal activity aimed at manipulating markets and deceiving regulators. Things like conspiracy with Bochewski, that arbitrager who relied on him for funding, aiding and abetting the filing of false statements, even helping someone file a false tax return. It was a systemic breakdown market manipulation, lying to regulators, tax evasion.
So that era burns out. But the focus on financial engineering doesn't go away, does it? As we move into the 90s and 2000s, we get the rise of hedge funds. And their focus seems even sharper, even more short-term. moving away from the complexity of restructuring a whole company in an LBO towards just exploiting tiny short-term stock movements.
That's a really good way to put it. It's like the focus got even more distilled, more purely financial. Funds like SA Capital, which became hugely prominent, really exemplified this. Their stated goal explicitly was not about a company's long-term health. Forget traditional investing philosophy. It was solely about finding and exploiting short-term movements in the stock price for profit. That's value extraction taken to an extreme, almost instantaneous level.
And to do that, you need incredible speed, incredible volume, right? What did that look like day to day?
The scale was just immense. There's this anecdote about SIE's founder, Steve Cohen. The firm was trading hundreds of stocks a day, hundreds of thousands of shares at a time, just constant churn. It's described as pure velocity, almost completely disconnected from the old ideas of value investing or holding for the long term. And Cohen himself, his clerk, mentioned this ability he had to just hold on to a position without flexing, meaning he'd stick to his trade, his bet on a short-term price move no matter what else was happening in the world, geopolitical crises, whatever. The outside world almost didn't matter, only the ticker tape.
Wow. And when you're operating at that kind of speed, that kind of volume, it feels like the internal controls, the compliance stuff, might struggle to keep up, or maybe gets intentionally left behind.
That seems to be exactly what happened. The speed and, frankly, the opacity of that kind of high-frequency trading made it easier for problematic behavior to fly under the radar. When the government eventually investigated SAC for insider trading and other issues, it came out that their internal system for catching suspicious stuff, like a pilot program to automatically scan emails for certain keywords related to trading, hadn't even started until 4 years after the specific trades the government was looking into had already happened.
4 years. That's an eternity in that world. It suggests compliance wasn't exactly priority number one.
It certainly looks that way. It suggests that the mechanisms designed to prevent abuse were lagging way behind the profit-seeking engine, maybe deliberately so. The priority was clearly the velocity of trades and profits, not meticulous internal governance.
Okay, so this relentless drive towards financial speed, short-term profits. It obviously has huge consequences, especially when we start thinking about wealth inequality and even how we define capital itself. Let's bring in Thomas Piketty's work here, particularly his insights on the capital-income ratio. What really jumps out is how the rise in private wealth seems linked to the decline of public wealth.
Yeah, this is a really crucial point and maybe needs a bit of unpacking. So the capital income ratio, basically it measures all the wealth a society owns, buildings, land, stocks, bonds, everything, that's the capital, compared to the income that society produces each year, like GDP. Piketty showed that when this ratio goes up, it generally means wealth is concentrating faster than economic output and wages are growing. And our sources really zero in on privatization as a key accelerator of this trend, especially in Europe.
So it's not just that rich people got richer through investing, it's that the public, the state, got poorer by selling off assets, and that wealth effectively transferred to private hands.
That's a big part of the story the sources tell. They look specifically at countries like France and Germany. Back in the 50s, 60s, 70s, net public wealth. So the government-owned assets like utilities, transport networks, maybe housing, minus government debt made up maybe a quarter, even a third of all the wealth in the country. But today, after decades of selling off state-owned enterprises, that net public wealth is down to just a few % of the total.
That's a staggering shift. We're talking about things like airports, energy companies, phone networks, assets that used to generate revenue for the public or provide services. Now they're in private hands, generating private profit.
Exactly. It represents this massive transfer of assets from the public balance sheet to private balance sheets. And naturally, this process disproportionately benefits those who already have capital to invest, allowing them to buy up these newly privatized assets. It's a huge engine driving the resurgence and concentration of private wealth.
And this wave of privatization, this difference in policy, might also help explain something else. Piketty flags. The divergence in inequality levels among rich countries. Like the tech revolution hit the US, Europe, Japan pretty much equally. But the explosion in top incomes, especially CEO pay, has been way more extreme in the US and UK, the Anglo-Saxon countries, compared to continental Europe or Japan.
Right. If it was purely about technology rewarding certain skills, you'd expect to see roughly similar patterns everywhere. The fact that we don't suggest something else is going on. And the sources point towards policy choices. Specifically, how aggressively countries embraced privatization and financial deregulation seems to be a key factor distinguishing the high inequality path of the US and UK from the somewhat more constrained outcomes in places like Germany, France, or Japan.
Which leads us right to that explosion in pay at the very, very top in the U.S. Primarily, it seems, for senior executives, CEOs of large firms. And the justification is always about their unique talent, their incredible productivity.
And this is where Piketty mounts a really strong critique of that narrative. He argues it's maybe rather naive to try and find an objective basis for these astronomical salaries purely in individual productivity. The core problem is, how do you even measure the marginal productivity of a CEO? There's only one CEO of GE or Apple or whatever. You can't easily compare their output to someone else doing the exact same job in the same context. The roles are unique.
So when the board's compensation committee sets the CEO's pay, they aren't really comparing measurable output against a clear market benchmark. They're doing something else.
It seems like they're defining status, perhaps. Piketty describes the justification, this idea of unique individual productivity driving the high pay, as something close to a pure ideological construct. It's basically a self-serving narrative, a way to justify maintaining or increasing the status and compensation of those at the very top, especially when their actual individual contribution is almost impossible to objectively measure against anyone else's. It helps perpetuate that concentration of wealth.
And this need to justify huge wealth, to craft a narrative around it, connects to another theme that runs through all these different eras of financial power: controlling information, using marketing, hype, or sometimes outright deception, especially when things are opaque.
Oh, absolutely. Information asymmetry is a constant source of power, and the Theranos saga is just a brutally clear, modern example of abusing that asymmetry. Internally, people at Theranos were apparently warning about overselling or overstating what the technology could actually do. But to the outside world, to investors, to the media, they projected this image of a revolutionary breakthrough.
And the deception was quite sophisticated, wasn't it?
Yeah.
Focused on specific technical claims. They talked about high precision, using coefficients of variation, or CVs, under 10%. For people listening, a lower CV means a more precise, reliable test.
Exactly. That 10 per CV claim was crucial marketing. They needed some technical data point to hang the hype on. But the sources showed two big problems. First, internal validation reports actually showed much higher CVs, meaning less precision for most of their tests. And second, that specific claim they advertised so heavily, the one under 10%. It apparently only applied to one test, their vitamin D assay, which is a fairly standard test anyway.
So they took one, maybe marginally okay result and used it to imply the entire platform was that accurate and revolutionary. A classic bait and switch using data.
Pretty much. A tiny kernel of truth used to sell a much bigger fabrication. And this wasn't just fooling investors. It directly compromised the healthcare system. Patients were getting results from these devices.
And the cheating went beyond just marketing claims, right? They
Yeah.
manipulated the quality control process itself.
Yes, that's what regulators found. A New York state regulator confirmed that Theranos' practices around proficiency testing, that's where labs test known samples to prove their equipment is accurate, basically amounted to a form of PT cheating. They were actively manipulating these external quality checks to make sure they passed, violating state and federal rules. They weren't just failing quality control, they were rigging the system to appear compliant.
You know, it reminds me of an earlier example, maybe less direct fraud, but still about controlling information through marketing muscle. The launch of Librium, the tranquilizer, by Roche.
Right, that's another case study in leveraging information channels. Roche didn't just invent the drug, they carefully managed its introduction. They apparently planted a favorable feature article about Librium and then poured money into advertising $2 million in the first year alone, which was a huge sum back then.
And where did they spend that money?
Critically, they spent it on lavish ads in medical journals. Journals that were, and often still are, heavily dependent on pharmaceutical advertising revenue to survive. This creates an obvious potential conflict of interest. The sources note that many of the claims Roche made about Librium's effectiveness weren't actually backed by convincing evidence at the time. But because these claims appeared in prestigious medical journals, outlets financially reliant on the advertiser, they gained an aura of scientific validity. It's using the dependency of the media to push your message, effectively monetizing that information asymmetry within the medical community itself.
Okay, let's bring this right up to the present. If we connect all these threads, leverage, information control, valuation narratives, the most recent and maybe the most powerful, shift involves tech founders and the control of digital infrastructure. Thinking back to the early 2010s, you had this absolute flood of money pouring into Silicon Valley, from hedge funds, private equity, venture capital, and the scale of that money actually changed the power dynamic, didn't it?
It really did. Historically, you'd think the people with the money, the banks, the VCs, the PEs hold most of the cards. But in Silicon Valley, during that boom, the FOMO, the fear of missing out on the next Google or Facebook, was so intense that the sheer volume of capital chasing deals actually flipped the script. The power shifted away from the investors towards the founders. Founders could demand better terms, keep more control, dictate the direction.
And when founders have that kind of leverage, they get to set the culture, often a really aggressive one. Look at Uber under Travis Kalanick.
Yeah.
He didn't just build a ride-sharing app. He explicitly fostered this culture of, what was it, employees as a private army of many entrepreneurs.
Yeah, with the simple mandate, conquer. It was all about growth at any cost, disruption, breaking rules.
And if executives or employees push back, question the ethics or the aggression.
Kalanick reportedly had a go-to response. He'd placate them with the promise of immense wealth, something like, "Do you know how much money I'm going to make you?" It boiled down to, stick with me, follow the aggressive plan, and you'll get incredibly rich. Financial reward trumped ethical concerns or internal dissent. Loyalty bought with the promise of stock options.
It feels different from, say, an older tech giant like Microsoft. Bill Gates also wanted to dominate, obviously. But his approach, his battle plan, seemed more focused on establishing the standard.
Right. Microsoft's motto was literally, "We set the standard." The goal was to get Windows or Office everywhere, make them indispensable, create these incredibly profitable cash cows, the operating system, the Office suite that generated steady revenue to fund further growth and solidify their dominance. It was about building a lasting structural advantage through the product itself.
Whereas some of the newer tech power seems built less on product standards and more on, well, what the sources call valuation magic, especially in the private markets. Before IPO, WeWork is the unavoidable example here, isn't it?
Oh, absolutely. The WeWork saga is almost a caricature of this phenomenon. You had sophisticated private investors, big names, Goldman Sachs, JP Morgan, Fidelity, SoftBank most famously, who were somehow convinced to ignore the basic reality.
The reality being.
That WeWork was fundamentally in the business of renting office space, fixing it up a bit, and then subleasing it at a higher price. A real estate business, basically, with physical limitations, costs, liabilities. But they were persuaded to view it as something else entirely, something revolutionary, tech-driven, incredibly valuable, a platform for community and energy. It was presented and valued like a high-growth, infinitely scalable software company, not a landlord. It was, well, a magic trick, as the source puts it.
A magic trick funded by billions in venture capital. And while the company itself was just burning through cash like crazy to keep up appearances and fuel that growth narrative, the founder, Adam Neumann, was doing pretty well personally, wasn't he?
Astonishingly well. He was using his own money, derived partly from selling some of his WeWork stock, back to investors like SoftBank at those inflated valuations to buy up properties. Over $100 million worth in San Jose alone, apparently, including, in one case, an office building that he then leased back to WeWork.
Wait, he bought a building and then rented it to his own company.
Exactly. So WeWork's massive expansion, its need for more and more space funded by investors, was directly enriching its founder's personal real estate portfolio. It highlighted this bizarre loop where the inflated valuation and cash burn were feeding the founder's personal wealth, even while the core business remained deeply unprofitable.
And then the magic trick stopped working when they tried to go public, right? The IPO failed spectacularly.
It completely imploded under public scrutiny. The valuation collapsed. The sources describe it vividly as a reverse metamorphosis, from butterfly back to caterpillar. The fallout was brutal. Thousands of employees laid off as the company was forced to slash costs and confront the reality that it was, after all, just a fancy office subleasing business. Neumann himself walked away with a huge exit package, but many employees lost their jobs and saw their stock options become worthless.
That pressure to generate revenue to justify valuations, you see it playing out across the digital landscape, don't you? Even on established platforms. Look at Instagram after Facebook bought it.
Yeah, there was apparently immense pressure on the Instagram team to hit Mark Zuckerberg's target of $1 billion in revenue pretty quickly after the acquisition.
And that financial pressure started to clash with Instagram's original identity, its user guidelines.
It seems so. Those early guidelines actively discouraged overly commercial behavior. They even told users stuff like aggressive self-promotion makes people feel sad inside, trying to maintain that authentic user-focused vibe. But hitting that billion-dollar revenue target, That required pushing more ads, encouraging more commercial use of the platform. So those early ethical guidelines about user well-being inevitably got pushed aside by the sheer financial imperative imposed from above. The platform's value shifted from user experience to monetizable engagement.
And looking forward, maybe the ultimate play for digital power isn't just monetizing attention on one platform, but controlling the entire infrastructure, consolidating everything.
Gotcha.
Is that the idea behind Elon Musk's vision for X, formerly Twitter, turning it into a super app?
That seems to be the ambition. The model often cited is WeChat in China, which isn't just social media. It's messaging, payments, shopping, booking travel, ordering food, accessing government services. It's woven into the fabric of daily life, often described as the remote control for life.
So if you control the super app,
You potentially control everything. Commerce, communication, information flow, payments. You're the central hub. You see all the data. You take a cut of all the transactions. You potentially host user-generated content, music, videos, articles, and decide how creators get paid or if they get paid. It raises this really fundamental question.
which is
Is the next, maybe the ultimate form of financial power concentrated not just in owning assets or companies, but in owning and controlling the essential digital infrastructure itself, the layer through which almost everything else happens?
that's a sobering thought. He who controls the rails controls the traffic.
Exactly. It's the ultimate choke point, potentially. Hyper-leveraged control over vast swaths of the economy and daily life. Hashtag tag outro.
Wow. Okay, so we've journeyed quite a distance today. From John D. Rockefeller Sr. carefully building consensus within Standard Oil to control physical assets, through the debt-fueled LBOs of the 80s, the barbarians at the gate using junk bonds, and landing now in this era of digital empires built on information, valuation narratives, and maybe ultimately controlling the infrastructure of our online lives.
Yeah, and looking across all these sources, despite the wildly different contexts and technologies, a few consistent strategies for accumulating and exercising power really stand out. First, successful capitalists consistently exploit information asymmetry, whether that's Roche planting favorable articles for Librium or Theranos outright cheating on medical tests to fool investors and regulators. Knowing more than the other guy or controlling what they know is key.
Right. And second,
Second, they often cultivate political or regulatory protection. We saw the hard cartels in Hong Kong basically getting government monopolies handed to them. We saw Thaksin Shinawatra using his political power in Thailand to actively block deregulation and hobble his competitors. It's about shaping the rules of the game in your favor.
okay, information asymmetry, regulatory capture, and the third,
And third, this recurring ability to translate private magic, often around valuation, into public wealth or market dominance. Think about WeWork convincing sophisticated investors it was a tech company, not a landlord, to achieve that huge valuation, even if briefly. Or even Ford selling himself as the guarantee of quality. It's about crafting the narrative.
and underpinning a lot of the modern wealth accumulation, as we discussed with Piketty, is that fundamental shift, the massive transfer of assets from public ownership to private hands through privatization. That really reshaped the whole economic landscape.
Absolutely. It provided the fuel, the assets, for a lot of this recent private capital growth. And maybe that brings us to a final thought, circling back to something we touched on. The power of non-public entities. We mentioned figures like the Koch brothers building vast fortunes in energy, largely operating as a private company without having to answer to public shareholders.
Yeah, and we saw similar dynamics with hedge funds like SAC Capital, operating with less transparency than public companies. Or even WeWork's crazy valuation phase, which happened entirely in the private markets, away from the glare of quarterly earnings reports and public market scrutiny.
Exactly. So here's the provocative thought to leave you with. Consider the immense power wielded by these private fortunes and private companies, from industrialists like the Kochs to secretive hedge funds to private equity firms restructuring companies away from public view. Do these non-public entities, precisely because they operate away from the scrutiny of public shareholders and often less intense regulatory oversight, do they represent the most durable, perhaps the most potent, and maybe the least understood source of economic power in our world today?
And if that's potentially true, how can we really grasp the full picture of global capital and its influence if some of its biggest players are specifically designed to operate as much as possible in the shadows?
Something to think about. Where is the power you don't see?